The biggest mistake you can make as an investor is not investing your money. And right now, that's about half of Americans. 40% of Americans have no money invested in the stock market. 50% of Americans have no money invested at all. And when you ask those investors who have money invested how much money they actually have in the market, the most common answer is, I don't know. And the second most common answer is about 25% of investors have less than $500 invested. So the question is, why is that the case? In my perspective, I think most people just don't know where to begin. I mean, it's not taught in school. When you're looking at either the media or news, everyone speaks about investing as if it's this super complicated thing. And I think that makes it so most people are confused and don't know how to actually begin. And that's what we're going to change in this video. We're going to make it very simple for you to understand the steps you need to take so that you can begin your investing journey right now. The very first step, and where most beginner investors make a big mistake, is they don't begin with the end in mind, or they don't establish the finish line. And if you don't set the goal, it makes it impossible to know where you're headed, if you succeeded, if you failed, or if you landed somewhere in the beginning. So the very first step is establishing what your financial freedom number is. The second component to this, and why it's so important, is not spending on something right now so that you can put money away for your future. That's not an easy thing to do. It can be really challenging. So understanding what your goal is will actually act as motivation to get you through those more difficult times. So how do you figure out what that financial freedom number is? First, you're going to add up all of your expenses. So rent, food, travel, entertainment, if you're a skateboarder, skateboard shoes, etc. Take that total and then you're going to multiply it by 25. So if your annual expenses are $50,000, you multiply it by 25, that's going to give you $1.25 million. That's the amount you're going to need invested to become financially free. Then you can pull out your $50,000 a year, which you're living off of the money that your money is making by being invested. And that number is really considering a 4% return on your money, which might sound low. And if I heard that, maybe the first thing I thought was, what if I could make 10%? Do I not need 1.25 million? Is it closer to $500,000? The reason why we put it a little bit low is because of two reasons. One, you have to consider inflation. And maybe in a time that's not outrageous like we're in right now, you would consider inflation at about 2%. So on that regard, you're targeting a 6% return so that you can hit your 4% draw without inflation eating it away. The other thing you have to remember is you're going to have years where the market outperforms your 4%, but you're also going to have years where it underperforms. So really what you're trying to do is establish the rate of return that doesn't bring your total investment down and that you can continuously draw on for the rest of your life. So you might be thinking $1.25 million, are you kidding me? I'm never going to save that. It's going to take my whole life to do that. The thing is, you're not going to be saving the full $1.2 million. You're actually going to use the power of compound interest to help you get there. Compound interest, which in my perspective is the best thing ever. It's when your money starts earning interest on interest. And when you start giving it time, oh my gosh, it starts growing like crazy. A good way to illustrate how your money can grow is by using the rule of 72. And this is when you divide 72 by whatever the targeted return is for the investment you're going to make. So if we're using the S&P 500, for example, which gave an average annual return of 10%, pretty much since existence, we would divide 72 by 10% and it would give us 7.2, which means at a 10% return, our money is going to double every 7.2 years. Another great example of using compound interest to make yourself incredibly wealthy is if you were 18 years old and you invested $300 every month for 8 years, you would have a total of $28,800. And if you stopped contributing to that investment, but let it continue until you retired, you would be able to turn your $28,000 into $1.8 million by the time you retire. So the power of investing and compound interest is really how we're going to get to that goal. It's not about just saving it until you get there. So we started with beginning with the end in mind, the power of compound interest. Now, when it comes to starting, what about making sure we start at the best time? Or maybe a better way to say it is, shouldn't I start when the market corrects so I get in at the best time? Now, timing the market is a losing proposition in my perspective, and I'm gonna show you why. So we're gonna use 5 different people in this example: Becky, Kyle, Stacy, Chad, and Karen, which are good names, right? And we're gonna give them $2,000 to invest every year, and we're gonna use the stock market's performance over the last 20 years. Becky happens to be the best market timer the world has ever seen. She would invest once a year at the lowest point every year for 20 years. Kyle, all about action, every time he got his money, he would invest it the first day the market opened. Stacy divided her $2,000 into 12 equal portions and invested $166 every month, or better known as dollar cost averaging. Chad was the worst market timer in history. He invested once a year at the highest points in the market. Karen kept her money in treasury bills, waiting for the best time to invest, and she never found that perfect time. Here's the results. Becky ended the 20-year investment with $151,391. Kyle, coming in second, totaled $135,471. Stacy in third, $134,856. Chad finished with $121,171. And Karen, being the big loser, finished with $44,438. So I started off talking about how you can't time the market. And in that example, Becky outperformed everybody. But here's the thing. It's impossible to do what Becky did. To time the market perfectly for 20 years, every single year, it just doesn't happen. But what I want you to focus on is if you look at Becky, Kyle, Chad, and Stacy, there wasn't that much variance when you look at the best market timer, dollar cost averaging, having your money in the market the longest, or being the worst market timer ever. All of them actually had a pretty good outcome. The one that really lost was Karen, who waited for that perfect time. The perfect time never happened. I know that sounds like, well, I would never do that. That's actually more common than you think, but finding that perfect time is actually tough to do. The next hurdle is, how much do I invest? And for this one, there's no right or wrong answer. I think the most typical way to structure it is the 50-30-20 rule, and how that breaks down: 50% of your expenses go to things you absolutely need, 30% goes to wants, and then 20% goes towards savings and investing, and then ultimately investing. My view is, if you can't invest 20% each month, do what you can and then set the goal to increase that over time. Now, there are people that want to retire early. This is like the FIRE movement. Now, they typically invest 50% or more of their income. That's a hard thing to do because you need to make a lot of money to be able to only live off that small of your income. So if that's the case, the majority of your energy probably needs to go to how you earn more income, and then as you earn, put everything towards investments so that you can invest early if that's your goal. Here comes the fun part, which is actually opening accounts and getting started. Now, I think you should start with tax-efficient vehicles, which would be a Roth IRA and a 401k. On a Roth IRA, you're investing post-tax dollars, you're letting it sit until retirement, and all of your gains are tax-free. You do have a max contribution, which is $6,000 for the year. Then you have a 401k, which is pre-tax dollars. You're deferring your taxes until you withdraw at retirement, and you can deduct your contribution from your taxable income. 401k, you typically have an employer match, so they'll match your contribution up to a certain point. What's cool about that is that's a guaranteed 100% return. Now, for the Roth IRA, where you open the account, mine's personally at Fidelity. Doesn't matter so much where you do it. It could be Fidelity, Schwab, TD Ameritrade. That one's more up to you. Okay, I've got my account started. I'm ready to go. What do I invest in? That's always the question, and it's the hardest one to ask because there's not one size fits all when it comes to investing. But Warren Buffett did say that 99% of investors should not try to beat the market. They would be better off by investing in a low-cost S&P 500 index fund. So Vanguard has an S&P 500 index, Schwab has one. Not saying to invest in those, but those would be a couple examples of what Warren is talking about. Something interesting to back Warren's point is a study came out in 2020 that looked at the last 15 years of the market. And it found that 90% of actively managed hedge funds actually underperformed the index. So that actually proves Warren's point in my perspective, and I think is a solid option for most people. One thing to add though, it's always best to do your due diligence, educate yourself, and getting professional help can make this process actually really good for the individual. So broad strokes, you're gonna match your employer match in your 401k, you're gonna max out your Roth IRA. If you're still looking for tax incentive, you can fund an HSA. If you wanna keep investing in the market beyond the 401k and Roth, you can open an after-tax brokerage account. You're gonna get to a point where you have a certain amount of investable assets where something like real estate opens up or other alternative investments. I didn't mention crypto. I'm just gonna say this, if crypto is something that you're interested in, just remember it is volatile. You can lose all of your money like that. So just make sure it's an amount that you are totally comfortable losing. But that's kind of the broad view of your investing strategy. Before you go, I want to leave you with this gem. This is something that the wealthy do that I think is going to change everything. When you're looking at purchasing something, what people typically do is look at the cost and then see if they have the money in their account to be able to pay for it, or they'll typically associate the time it will take for them to work to then pay for that item. So if something's $100 and you make $20 an hour, what most people do is look at that and go, okay, crap, I gotta work 5 hours to buy that item. What I want you to do is if something's $100 or whatever the cost is, divide it by 0.04. And what that's gonna show you is how much money you need invested to really buy that item. So on that $100, you divide it by 0.04, it's gonna give you $2,500. Once you have $2,500 invested, the return from that investment will pay for your purchase. The reason I want you to do that is when you start looking at it through the lens of I can buy things based on the interest my investments are making, it is gonna get you to the path of financial freedom way faster. And that's ultimately our goal for all of us to do. We hope this video offered a ton of value. If it did, all we ask for is just to hit the like button. And if you want to continue educating yourself on finance and join us in our journey to achieve financial freedom, hit the subscribe button and let's run through this together.